Okay, I think everybody is in. So good afternoon, everybody, or good morning or good evening, depending on where you are in the world. And welcome to the Service Department News 2021 Trends webinar. Today's session is kindly sponsored by Saxbury. Saxbury represents commercial landlords and developers of alternative operational real estate across the UK, with a unique focus on the service department sector. It provides all-encompassing support for apart hotel and development projects, acting as part of the inner sanctum of advisors and decision makers for their clients. Their experience spans operator search and selection, investment sales, and structured finance for projects in a range of lot sizes. And I'm glad to say that Adam from Saxbury is with us, and when we introduce our speakers later, he can tell you a bit more about what those guys do. So, we normally do a trends article of Service Department News looking ahead to the next 12 months. And it's pretty safe to say we didn't see what was coming this year. 2020 has been a momentous year for everyone in hospitality. Most of it's been pretty negative, for obvious reasons, but our sector has weathered the storm much better than a lot of other hospitality and real estate asset classes. And I think 2021 is a huge opportunity for this industry to capitalise on the gains it's made in the last few months in terms of recognition, awareness and performance. And today we're going to talk about a few of the things that we think are likely to happen in 2021. So just a few housekeeping rules. Unless you're one of our speakers, if you wouldn't mind keeping your camera and audio off, that would be great. The format of the session is that we're going to speak about 6 different trends. I will talk through 3 of them using some slides. And I've got guests here to talk about 3 of them, and we're going to have some brief Q&As. If you have any questions for me or any of the panelists during the session, please use the chat function in Zoom and submit them there, and we will try and get around to answering some of those at the end of the session. And for everybody who's registered for the session, there'll be a recording available which will be sent to you via email, I think tomorrow. Finally, I'm up in London in a serviced office today, and there's quite a bit of building work going on behind me, which is just kicked off. So apologies if you can hear any background noise there. Hopefully it's not too bad. My name is George Sell. I'm the editor of Service Department News and editor-in-chief at International Hospitality Media. And we are an online publisher of B2B websites for the hospitality industry. And we're also an events organizer. That has proved rather tricky this year, but the webinars have been a great way to keep in touch with our audiences and indeed to grow our audiences. Got a fantastic panel of speakers today who will be talking about some of the trends. I'll ask them each to introduce themselves at the start of their particular segment, but I'm really pleased to have Adam from Saxbury, Olga from Ekkist, and Andrew from AHV Associates with us. So thanks very much to you guys. So our first trend is service departments pivoting to leisure demand. Business travel makes up a huge amount of business for a lot of service department operators. In some cases, it's nearly the entirety of their business. But obviously that has been hit extremely hard by the pandemic. A recent report from Report Link has said the global market for business travel is expected to decline by 54% this year and 45% next year. When in the early days of the pandemic in April, the GBTA reported that their members saw 98% of their business travel cancelled internationally, and 92% of domestic business travel was also halted. And just last week, Bill Gates predicted that business travel and office work will not return to pre-pandemic levels. A lot of people are trying to make predictions of how we will go back to work when things are a bit more normal. Gates believes that around half of business travel won't come back, along with around about a third of working in the office. But this offers a fantastic opportunity for service departments to broaden their reach, to attract a new audience and to focus more on leisure demand. And by virtue of the fact that our sector offers self-contained accommodation, which allows guests to avoid contact with other people, that means the sector can take a greater share of leisure travel in 2021. The strict hygiene protocols introduced by virtually all branded service departments offer guests more assurance than Airbnb style accommodation, which isn't so consistent or indeed highly regulated. And we're already starting to see anecdotal evidence from operators that they are seeing an increase in leisure demand in the tail end of this year, which can only get stronger into 2021. Simon McGrath, the CEO of Accor Pacific, which operates the Sebel brand in Australia and New Zealand, said the sector's been growing rapidly in popularity, and he's expecting to see a further boom in this area, particularly in the current climate. Service departments limit unnecessary contact with other guests and offer a safe and secure way to travel. And the Sebel has a 75% leisure to 25% corporate guest ratio, which is a long way in that pivot towards leisure already, and that's a lot further on than most developers. A bit closer to home, Guy Nixon from Native, who is about to open a new property in Edinburgh, says even with the challenges of this year's global pandemic, leisure demand for apart hotels has been buoyant in the months coming out of lockdown, and we're well placed to capture post-COVID demand. Tom Walsh of Stay City says it's apparent that full recovery will take some time to achieve, but the recent news of the success of the vaccine trials is positive news for the future. Leisure travellers have already demonstrated a demand for short breaks and city-based staycations nearer to home, and we're well placed to see our occupancies rise as a result. Excuse me, particularly as our self-catering apartments make social distancing easier. And just in the last week, Oakwood has launched quite an intriguing new soft brand called the Unlimited Collection, which allows properties to retain their individual identities and benefit from marketing expertise. And that's predominantly targeted at a millennial audience, mainly made up of leisure travellers. So that's our first trend, and now I'd like to move on to the first Q&A, in which we will be looking at healthy buildings with Olga Turner-Baker from Ekkist. So Olga, before we start the Q&A, could you just briefly introduce yourself and tell us what you do?
Absolutely. So my name is Olga Turner-Baker, and I run a design consultancy called Ekkist, which is one of the UK's leading consultancies in healthy building certifications. We primarily work with the World Building Standard, which is the world's leading human-focused building code. So rather than look at how the buildings impact the environment, we look at exactly how a building impacts your health. So that's what we do in a nutshell.
Great, thanks Olga. So can you give us a bit of background on the healthy buildings movement and what it's trying to achieve?
I think the healthy building movement is really something that's evolved a lot in the last 5 years. Certainly when we set up in 2017, it was still very unknown and nobody really was talking about it. The Well Building Standard itself was founded in 2014, and we've seen a huge amount of growth. It's really leading the healthy building certification sector, being the largest of those certification types. What's interesting is actually the geographical distribution of standards like this. So if we look at Well, there are over 11,000 projects undergoing certification at the moment worldwide, but only 1,400 in the UK. So although it's a growing sector, there's still huge scope for it to evolve even further. And then alongside that, you've got other certifications like Fitwell, and then more specific ones around air quality, such as air rated and reset. So it's a massively growing market. Oh, George, I've lost the audio on you for some reason. You might just have to say that again.
How's that? Is that better? Can you hear me now?
Yes, sorry, apologies.
No problem. Let's focus on the hospitality sector specifically. How far down the road are hospitality building owners and operators in terms of the health and well-being journey?
I think it's really interesting to look at the difference sort of between how different hotels and hospitality industry in general are tackling this. Some are doing it very, very well, but in very specific sections. So some are doing the construction side and looking at things like air quality or water purification, and some are doing management brilliantly. So there are examples of great programming, great events, there's medical focus in a lot of them in your spa type setup. But very few are actually looking at this holistically. So looking at both the physical side of a healthy apart hotel or just a general hotel, and that involves looking at the materials you're building with, the ventilation systems you're fitting out, the water purification on site, but also what kind of furnishings you're using, and then how you're actually operating that space and what you're offering. So you see little micro pockets being done absolutely brilliantly, but very few doing it holistically, and very few have actually gone through any formal certification.
Okay, and on the chat we had earlier, you mentioned that really the apart hotel and service department sector is at the very start of this process. But are there any companies in the hospitality, the broader hospitality sector, who are doing things particularly well?
I think brands like Aman obviously doing a fantastic job. They have detox programs. They're very informed setup around things like forest bathing and about actually the location of where they are in relation to people's well-being. So understanding that being connected with nature and the natural environment is as much part of their offering really as the physical building. I know that's going to be different in urban environments, but there are still things that the apart hotel sector can do in terms of biophilic design, bringing indoors in, looking at acoustics and things like that, which isn't yet done. I also like the Viva Maya brand very much. So they look at, again, a lot of medical spa type programming, and they use a lot of daylight in their buildings. We know that's fundamental to our health. So not only sleeping well at night, but waking up to natural light and being surrounded by that is really, really important. So that's something that there could be a lot more focus on, I feel, but isn't a lot in the industry at the moment.
Operations and construction of hotel buildings is starting to take into account sustainability, and I know that overlaps quite a bit with health and well-being. But in new build projects, what health and well-being measures would you expect to start seeing in new apart hotel buildings that are coming up?
I think accountability is going to be a huge issue going forward. I think given what's happened this year and given the crisis that we've had, people are going to want reassurance from where they're staying, and we're going to see a lot more go through that formal framework of whether that's having a health and safety consultant having looked at something very thoroughly, whether it's having engineers look at their ventilation very thoroughly as well, or whether it is going through a formal certification process like WELL, or the smaller version of it, which is the WELL Health and Safety Rating, which a couple of hotels in the US I know are looking at. So I think there will be a huge move towards that more rigorous process to reassure people that when they are coming into these environments, that their health has been holistically considered, and that is really a genuinely safe environment. I think that'd be a big trend going forward.
How easy would it be to retrofit an existing building to incorporate some of these measures?
It's actually more straightforward than we think. So recently we've been doing a lot of research as a company about something called single room MVHR. So it's actually ventilation that can be fitted not as a building wide system, but actually per individual room. So whether that's in a dwelling, an office or a hotel, as long as you've got some kind of external facade, you can actually fit in an air filtration system per room. So I think that's something that's really easy. But then in terms of really straightforward retrofit, you can use natural paints, and there are even paints out there that can improve indoor air quality. So they absorb toxins from furnitures, lacquers and things like that, formaldehydes. If you're an apart hotel on a busy road and there's benzene and things like that, there are actually paints that will either absorb that or neutralize that. There's companies like Airlight and a few others. So I'd really look into that as well.
And we've spoken before about how buyers of new homes are now putting this quite high up the agenda in terms of what they're looking for in a new property. Do you think that hospitality guests are also demanding this now of operators? Is this rising up their agenda too?
I think very much like sustainability did a few years ago, right? So before it was something that some people thought about, now it's something that a lot of people think about and take into consideration when looking at, you know, whether they're going to rent somewhere, buy somewhere, spend holiday time there. I think well-being and healthy buildings are now as much considered as sustainability. People are saying, well, this is going to be one of the biggest investments I make in terms of my leisure time. I'm actually going to invest in somewhere that's going to make me feel better and support my health. and not just be somewhere trendy that I want to stay. They'll consider that too, but they'll also look at the sustainability and the wellness of the place they're staying in.
Yeah, great stuff. Thanks very much, Olga. Olga's contact details, along with all our other speakers, are in the chat there. So if you'd like to get in touch with them and continue the conversation, then please do. And also, if you have any questions for our panelists, please submit them in the chat and we'll get around to answering some of those at the end. So the next trend is hotel groups rush to launch extended stay brands. So the extended stay hotel sector, particularly in the US, has massively outperformed the wider hospitality industry for a number of reasons. And since the recovery has started, it's reported a bigger growth in occupancy than the hotel sector as a whole. Astonishingly, the economy extended stay occupancy for Q3 of this year is just 0.8% down to the same period in 2019, which when you consider what has happened is a pretty phenomenal statistic. Mark Skinner from the Highland Group, which monitors the performance of the sector in the US, says across all metrics, extended stay hotels continue to perform better than the overall hotel industry 6 months following the start of the pandemic. Occupancy is now higher than during the low points in 2009 and is rapidly approaching parity with quarterly occupancy during the last recession. This was a couple of months ago that report came out, and the numbers have continued to improve. So obviously this has been noted by operators, and we're already starting to see the beginning of what I think will be quite a big wave of new extended stay brand launches. So Red Lion Hotels has relaunched its Guest House International brand. It's now called Guest House Extended Stay, an upper economy flag suitable for conversions. IHG announced the launch of its Atwell Suites brand last year, and it's set to open its first property in Miami next summer. Karen Gilbride, who heads that brand, says, "We created Atwell Suites as a result of continuous collaboration and dialogue with an enthusiastic advisory board comprised of IHG owners to offer travellers something truly different in the upper mid-scale space. The all-suite segment is fast growing and remains very resilient with strong owner interest throughout 2020. We're excited to continue the momentum of this brand and look forward to welcoming our first guests next year." Magnuson Hotels is another that's launched an extended stay brand and is opening its first properties in Texas and Ohio this year. And we're also seeing established brands taking advantage of the situation to move into new markets. So a proposed Park Inn residence property in Port Charlotte, Florida, will be Radisson's first extended stay property in the US, if approved. That's currently in the planning process. IHG has opened a Staybridge Suites property in Dubai, its first in the Emirate. And the first UK Hyatt House property opened in Manchester early this year. I think we may well see some of the major hotel groups moving some of their brands, which have been very successful in the US. I think we might see them come into Europe as well. Obviously IHG and Marriott are here. Hilton and Wyndham and others haven't followed suit yet, but I wouldn't be surprised to see that happening. And there's some other intriguing new brands around the corner. So Navneet Bali, the former chairman of Meininger Hotels, has launched a new brand this year called Live In, an extended stay and transient hospitality concept, he calls it. And he's looking at initial locations, including Amsterdam, Paris, Berlin, Hamburg, Barcelona, and London. Live In is aimed at young people and will provide spaces to live in for work and travel. It will feature communal spaces and facilities, as well as state-of-the-art health and safety features. That's one to watch out for next year. So now it's time for another Q&A with Adam Lowenthal, co-founder of Saxbury. Adam, do you want to briefly introduce yourself and tell us what you do, and then we'll get stuck into the next trend?
Sure, thanks, George. Yeah, Adam Lowenthal, co-founder of Saxbury. As George explained, we're specialist real estate advisors to the UK service department in the hotel sector. But I think really, he explains sort of what we do. It comes real estate, whether it's leasing, investment sale, etc. But I really wanted to emphasize, I suppose, my partners and my passion for the operational real estate and the continuous evolution of alternative accommodation in the UK, and particularly the service apartment and apart hotel sector. So we might be specialists, but we're particularly passionate about this very interesting and evolving subsector of hospitality.
Great, thanks, Adam. So we're going to be talking about the potential return of the asset-heavy operator, or to put it another way, having OpCo and PropCo under the same ownership. So Adam, the two biggest deals in the sector in recent years, the Brookfield Seiko deal and the very recently announced APG and Superware investment in City ID, have seen the formation of groups with OpCo and PropCo under the same ownership. So why do you think this is? What are the advantages of this structure? And which is different from the norm in hospitality in general, which has been generally pursuing an asset-light structure?
Yeah, so the norm is the landlord, generally the landlord wants the highest rent with strong covenant, and the operator wants to pay the lowest rent, best product, and essentially they're on opposite sides. And often operators find it hard to find suitable assets for their operation, and the landlord developer often finds it hard to find a suitable tenant with the right covenant for their assets. So by creating these partnerships between the OpCo and PropCo, we believe it creates an alignment between the two sides, as they both benefit from each other's successes. And then building these fit-for-purpose assets for the OpCo creates genuine value in the PropCo and the OpCo elements. And then, of course, in the examples that you've given, you throw hundreds of millions of dollars, sterling, or euros, and it really supercharges that platform. So in theory, they should be growing at a very rapid rate relative to, I suppose, a asset-light model. I think another point worth noting is that a lot of funds and institutions, certainly in the UK, have looked at operators and leases in the sector, and they found them to be slightly below sort of investment grade. And so therefore, they were taking the risk of the downside of the ops via the lease without potentially the upside. So by partnering with a best-in-class operator, they managed to reap the benefits of both parts.
Okay, thanks, Adam. Do you think the structure is likely to become more popular, and is it only viable with the financial clout of an APG or a Brookfield in the driving seat?
Yeah, let's face it, there are a lot of landlords out there who are operating their own stock, and that might be cottage industry, whether you're an Airbnb operator or you're a smaller operator developing your own stock, small blocks across the country. So I don't think it's about the scale. It can be done at any scale, but I think, let's face it, is that most operators would love the opportunity to benefit from PropCo growth, thanks to their brilliant ops, but their focus is to grow their operation. So we still believe that most operators will stay asset light and perhaps go one step further by not even offering leases and follow the sort of traditional HMA route, especially after a turbulent pandemic, where being light and nimble, I think, was really the key. We do, however, believe real estate investors in the sector are likely to choose this strategy over the simple leasing assets to operators, as I think they can, again, as I said before, reap the rewards of a great OpCo and creating value in their PropCo. But ultimately, it depends on one's access to capital, investment, their growth strategy, and perhaps the belief in the real estate market we're talking about. So you can be an amazing operator, but a useless property developer investor, and vice versa. So I think sometimes it's hard to be both, let's face it.
Yeah. And in the more traditional case where the OpCo and the PropCo remains under separate ownership, do you think one of the legacies of the pandemic could be a more collaborative relationship between landlord and tenant, potentially even leading to the demise of the traditional lease? Will we see different structures?
The master lease model has traditionally worked well, but I think what the pandemic has really shown everyone is that the lease is not as certain. So if as a landlord, you're potentially going to inherit some operational risk and downside, so you may as well take some of that upside too. So as a business, and I think probably this is happening across the board, is that we've spent the last 9 months finding balanced solutions where the operator and landlord become more aligned and collaborate whilst maintaining the investment value, which is obviously key, and the sustainability of the long-term operation and income. So we don't think it's the end of the master lease, but we're creating and evolving the new structure of these leases to benefit both sides for the future.
We've seen in some industries and to some extent in hospitality, turnover related leases and various other structures. Do you think this is going to become a more regular thing in the apart hotel sector?
Yeah, so I was sort of hinting at that. These are probably the route they're going down, being more collaborative. I think these hybrid leases, it might only be for the first X number of years till you get to a stabilized point and everyone's sort of more comfortable at the fixed rent level. But certainly at the initial years, there may be some of those things going on, and we've created some quite interesting structures with some of the operators in the last 9 months, which take into consideration the operational risk, especially after post-pandemic.
Thanks, Adam. And finally, you guys have got a pretty good overview of the sector, particularly in the UK. Are you optimistic for 2021 in terms of the number of projects forthcoming, and has progress been stalled significantly by the pandemic, or are most of the projects you've been involved in going ahead?
I think we've been really lucky, and you mentioned it earlier, that service departments and hotels have managed to weather this better than a lot of other sectors, and particularly obviously hotels, traditional hotels. We have been very busy with new projects, keeping together the old projects, and we see 2021 as a positive year. I think there'll be a lot of new opportunities. Unfortunately, there will be some casualties, clearly, but I think we're very fortunate to be in this sector of hospitality. And as you said earlier, the fact that you are self-contained in your own unit and things, that's clearly very attractive, not only to the guests, but obviously the operators now, as you said in your previous slide, growing their new brands into this sector.
Great stuff. Thank you, Adam.
Thank you.
Adam's contacts are in the chat there, so if you'd like to carry on a conversation with him, please do get in touch. Now, our next trend is workations, which is another one of those horrible hybrid words like leisure that have suddenly become the norm. But this is quite an interesting one. The broader hospitality sector has really got a hold of this, but I haven't yet seen too much coming from the service department and apartment sector in terms of marketing and appealing to this audience. But I think this is actually a huge opportunity. So we've all heard about the digital nomad phenomenon, which has traditionally been thought of as young creative professionals who can work from more or less anywhere with a decent Wi-Fi signal. But this phenomenon is being expanded as millions of workers and their employers have found they can do their job perfectly well remotely. These are people who were commuters and in the same routine for decades, and this has actually been quite liberating to them. A lot of hotels in the UK and further afield have spotted this gap in the market and have been launching workation packages to allow people to work remotely while enjoying the surroundings of a hotel. And it's not necessarily the kind of properties that you would imagine. For example, Duke's London in Mayfair, a lovely hotel, is offering a very high-end workation package, including dedicated work butlers. They offer upmarket stationery, champagne at the end of the day, and various other nice touches, as well as the things that you would expect, such as printing and scanning services and healthy menus. In resort locations, if we could just go on to the next slide, Justin, please. Thank you. So resort destinations such as Barbados and Bermuda are actually offering a new form of visas, so people can take advantage of this phenomenon. So you can apply for permits to work remotely for the islands for a year. And hospitality operators, including Marriott, several of their resorts in the Caribbean, have announced new extended stay workation packages, combining all the technology and connectivity that workers need. And these packages are designed not only to allow travellers to continue their virtual commute seamlessly, but also to provide downtime and leisure options, which in turn can help spark new inspiration and productivity. So this is about, keeping your work-life balance in check. If you're disciplined enough to spend your day working at your computer when you can see a Caribbean beach outside the window, then you're probably a better man than me, but there's some really interesting options coming up there. There have been one or two operators in our sector who've been ahead of the curve. Amsterdam-based Yays started marketing to this digital nomad audience back in early 2019, offering specific workation packages, giving guidance on choosing affordable, fully equipped accommodation with reliable internet connection in places where team members can make the most of both their working hours and their leisure time. So I think Workations offer a great opportunity for service department operators to capitalise on some of their key strengths. Some of these include bigger self-contained units and locations in the heart of their communities. The corporate road warrior is going to be a rare reciting in service departments in 2021. This is a demographic that made up a big proportion of the sector's business globally, actually. But there's potentially a huge market of newly mobile independent professionals who can help to fill the vacancy void that they leave behind. So our final trend is a predicted wave of investment and M&A activity. And I'm going to talk about this with Andrew Harrington from AHV Associates. So Andrew, if you'd like to quickly introduce yourself, please.
Sure, yeah, thank you, George. So my business is AHV Associates, been around 20 years. We do an investment banking boutique. There are 4 full-time people plus me. And we do M&A and capital raising, mostly in the hospitality space, all for privately owned businesses. So we advise on selling, buying, raising money, and that's it really. More information on our website.
Very good, thanks, Andrew. So let's kick off by asking you what you think will be the main effects of the pandemic on the service department investment and M&A landscape in 2021.
Yeah, sure. I mean, obviously what's happened with the pandemic this year has illustrated the great business model that the part hotel, extended stay, service department, whatever name you choose to give it, has, right? The lower sales costs and the higher operating margin, all that sort of stuff, which many people, including many on this webinar, have been saying for many years. It's really illustrated this year the validity of that business model. Now, funnily enough, I actually disagree with the general consensus in the sense that I don't think that people who would otherwise stay in hotels will want to stay in apart hotels in the future because it's bigger and more remote from other people. I think people's memories are short. We'll get back to normal much quicker than people think. But what will happen, in my view, is that you'll get a lot more investment in apart hotels and similar product because it's a great business model, and in Europe we are underserved, right? If you compare the number of extended stay products, number of products offerings in the extended stay sector in Europe per head of population with that in Asia and with the US, we're still well behind. So you're going to see a flood of investment in the space because it's a very attractive business model. That will result in more M&A and more capital raising from professional investors. And the whole Stay City transaction, George, which you referred to, or somebody referred to a few weeks ago, that's actually quite illustrative of what is going to happen. There were a lot of people interested in taking a stake in Stay City. They eventually went with one, the Ireland Strategic Investment Fund, but there was a lot of professional money interested in that because it's a very, very good business model. And I think we're going to see a lot more of that in the next year.
Were some of these companies who expressed an interest in Stay City perhaps investors who hadn't considered the space before but have been alerted to it by how resilient it's been over the last 8 months?
Well, the people, the private equity companies who were interested in it were all, you know, pretty seasoned hospitality investors. So the direct answer to your question is no. However, the broader question is, are more people going to get interested in it? Oh, for sure. Oh, for sure. I mean, you're finding real estate people right now who you know, maybe might own one or two hotels, but it's not really part of, or a small number of hotels, but it's not really part of their key investment focus. They are now looking very seriously at the apart hotel space because it's shown its resilience in the worst of all possible times, and that's highlighted the great business model that it is. It's not that they want to invest in it because, you know, all of a sudden people are not going to want to be with other people in hotels or want to be on their own in apart hotels. It's not because of that, because I think that's all going to go away fairly quickly. It's because it's a great business model. That's why.
I spoke to Tom Walsh recently, actually, and he said one of the reasons that they were attracted to the ISIF investment was because ISIF had a much longer term view than a lot of the PE guys who were looking at the do you think, I mean, that's understandably an attraction as a business owner and operator. Do you think we're likely to see more sovereign interest in this industry? Is it of a sufficient scale now to get those guys excited?
Yeah, I mean, we already have sovereign interest in the industry. I mean, Mapletree is owned by Temasek, the government of Singapore, or one of the arms of the government of Singapore. And I think, you know, the problem with sovereign, I mean, ISIF is a very small sovereign wealth fund, right? Because Ireland is very small. And most of the big sovereign wealth funds wouldn't get out of bed for anything less than 10 or 15 times the investment that ISIF put in Stay City. So the answer to your question is yes, and there already is Temasek involved in Mapletree. Will there be lots of investment in the space from sovereign wealth funds? Answer, probably not in the next 5 years, simply because the size isn't there.
Okay. And what about consolidation and M&A between operators? Do you think we're going to see fewer but stronger operators by the end of the year?
Yeah, I mean, there's no question. I mean, the end of next year, not the end of this year. Yeah, no, completely. I mean, you've already got 3 private equity or family-owned substantial companies in Europe, being Adina, Eden, and Short Stay Group. And, you know, they are all, I'm quite certain, looking for acquisitions. I think you're going to get more of that sort of stuff. So you're going to see consolidators coming in or are already in and affecting the consolidation. The issue for a while will be pricing, because I don't believe there's going to be a lot of discounted assets available. There will be some, mostly troubled assets that were troubled a year ago, right, or 18 months ago. And I think a lot of the buyers will want discounted pricing. So the real question is whether, you know, when that pricing gap can, you know, it is bridged. But I absolutely think that over the course of the next year, you're going to see a lot of M&A from consolidators, from new private, you know, from private equity companies coming in, from Asian and American companies coming in for the first time. You know, I think you're going to see a lot of M&A for the reasons we've discussed.
Do you think any of the major hotel groups could be in the market for some of the smaller service department operators? I mean, Accor, for example, seemed to be back on the acquisition trail after a brief lull in the pandemic with their Ennismore deal. Could they be looking for an apart hotel operator, for example? Well,
Accor have got Adagio, of course, which is their JV with Pierre Vacances. I think you're going to see, you know, I mean, I think you mentioned Radisson, George. I mean, they've made a public statement, I think, saying they wish to expand a lot in the sector. It's an obvious gap in Wyndham's portfolio. I mean, they do have products in the US, but that's just about it. I think they've got 1 or 2 in Europe. I can't remember, but it's not mainstream. So that's clearly a possibility as well. So, yeah, I think you are actually. I mean, Adagio fills a particular part of the market. Accor probably will want to extend their footprint in Europe.
About 10 different lifestyle hotel brands. So I guess they wouldn't want to limit themselves to just one.
Yeah.
One in this sector.
Exactly. I mean, you've got IHG, of course, with Staybridge, and you've got Marriott with Residence Inn. They're clearly going to. I mean, you know, they've been really pushing those in Europe for the last several years, and I'm sure they will renew their efforts to expand those footprints as well. And we've had a Hyatt come along in Europe, in the UK. I'm sure they're going to extend that as well. So I think you'll see all the brands making big pushes in this area.
Yeah. And just looking for a second at the more the broader hospitality sector, you guys have just published your research report, which is pretty bullish about next year. Do you want to just give us a quick summary of that?
Yeah, sure. I mean, you know, I look at things obviously from a sort of capital raising M&A perspective, because that's my life. You've got some very interesting things happening right now. First of all, you've got zero interest rates and masses of money in the private equity and the private debt markets. You've got banks with double the levels of capital they had 10 years ago, 11 years ago. You've got operating margins set to increase because a lot of the hotels, including the apart hotels, have used the last 6-9 months to reduce costs and permanently reduce costs. It's particularly the hotels, because apart hotel costs are relatively low in any case, but particularly the hotels. I mean, I forget who it was, one of the, Marriott it was, said that they thought on average the cost base of their hotels, the hotels for which they have flags on, was 3 to 5% less permanently because of the cost savings that have been made. And we're seeing this across the board. So we're starting 2021 with a permanently lower cost base. Secondly, the evidence of Asia, the US, and here in the July to October period is actually people want to stay in hotels, right? They want to stay in hotels. They want to go to hotels. I don't buy this stuff that they don't want to be near other people. I simply don't buy it. There's a small number of people are like that. The vast majority of people want to get back to normal as soon as possible. And we've seen that in the July to October period. So with the vaccines, and so there is an end game to this, I think the first quarter next year, you're going to see a boom in bookings, for hotel bookings and travel bookings for the summer, or maybe sort of beyond April. You're going to see a lot of M&A, a lot of capital raising, because the vast majority of hotels are going to survive this. The marginal ones will go under. They're always going to go under, or they're always going to be in difficulties. Banks are generally very supportive. They will be supportive once the period of covenant waiving, etc., ends, and they will be willing to lend more money. And they have been willing to lend more money because their bank capital is very high. There's masses of surplus cash. So you put all that lot together and you come up with a really, really positive scenario for next year for hospitality, which is great because this year's been crap.
Yeah, indeed. Thank you, Andrew. If anybody has any questions, please do pop them in the chat. I'm just going to kick off by revisiting something that we were talking about briefly before the session started, which touches on what Olga and Adam are both doing. And Adam, I was just wondering if you could tell us what you can about the project you were describing earlier, which has got the fantastic sustainability and well-being elements incorporated into it, and if you think you're going to see more of that in the future.
Sure. Well, I'm no expert, unlike Olga, but yeah, no, we're involved in a really interesting project in Southwest London, and where the developer has decided to go down a really interesting sustainable route, and that's not only in terms of sustainability in the operations, but actually sustainability in the build. So we think it's going to be sustainable sustainability. I don't know if that's a term, but effectively, yeah, the operator coming in will enjoy the benefits of putting in incredible sort of carbon-free development site, amazing energy. The amount of energy being produced there, all the energy being produced is within the building. So yeah, it's very exciting, and it's going to really help on the planning side as well. So yeah, watch this space, and we'll hopefully be able to give some more information shortly.
It's interesting you mentioned planning, Adam, because quite often healthy building certifications we found in other sectors like residential or commercial have helped schemes get through planning. So just as important as it is to mention that, you know, you're going for BREEAM outstanding or something, or that you're going for really high sustainability, they've been mentioning they're going for high well-being as well, and plans have been responding to that really positively. And there's a huge amount of overlap between sustainability and well-being. Quite often you find if you use a material that's like Green Guard Gold certified or Cradle to Cradle certified for environmental benefits, it's also a material that's good for our well-being because it's been tested for health benefits too. So there's actually a huge amount of crossover. So if you're already looking at sustainability a lot, you're going to be about a quarter of your way on the way to well. There's been some research out on the overlap, and they're saying it's about 25% with a lot of these standards.
That's really interesting. Thank you.
Thanks, Olga. We have a question here for Andrew from Ali Tariq. And he says, how do the smaller fish in the pond survive the next year? As Andrew said, that the bigger companies will get through, but the smaller companies will be affected. How can we prevent this from happening?
Well,
Well done, Andrew, but give it your best shot.
Yeah, no, I didn't actually say that. What I said was the ones that were marginal a year or so ago, you know, are going to struggle to survive. Well, you can have marginal big companies, marginal little companies, etc. I mean, there's a whole load of really, really good, you know, smaller businesses who are doing very well and will be able to raise capital. And indeed, we work with, you know, we're advising a couple of them now on raising capital, and there will be capital there because they're good business plans and good businesses, and they've got good business plans. So, you know, there's capital all along the spectrum, from the small to the large. My point is the ones that will not survive are unfortunately the ones who were struggling pre-pandemic, right? And this could well knock them out, unfortunately. But the vast majority will, and there's some fantastic smaller companies there who will be able to raise money and prosper and thrive, just like the bigger companies.
Thanks, Andrew. We are running out of time, unfortunately, but I just wanted to firstly say thanks very much to Adam, to Andrew, and to Olga for sharing their insights with us. I think it's been an invaluable session and give us some really good pointers to the year ahead. Thanks again to Saxbury for sponsoring. Actually, I'm just going to squeeze one more question in because it's just appeared in the chat now, and it's a good one. And I think sorry, Andrew, I think this one is for you again. This is from Maria Ashton. Can deals get done without balance sheet participation in this environment, whether it's leasing, key money, or income guarantees?
Yeah, because there's huge amounts of money around looking for good opportunities. I mean, it's going to be more expensive if you don't put money in. There's no question. Is it going to be prohibitively more expensive? No. Because you know, there's billions of dry powder in private equity and private debt. There's massive amounts of surplus capital in the banks, and there will, you know, it'll be more expensive, but the good business plans with good businesses will get funded.
Yeah. Okay. Thanks, Andrew. Marcus Linhart says, what are your thoughts on co-living as an asset and an opportunity for the hotel industry as it struggles? Let's kick off with you first, Adam, actually. Have you been involved in any co-living projects, or is it something that you're considering?
Yeah, I mean, I think so. Yeah, we have. We've actually been brought in on a number of opportunities from developers and investors who are, to use the word pivot again, but in terms of having to consider pivoting to away from, say, C1 hospitality and go into, you know, co-living, PRS, built to rent. Because, I mean, let's face it, and we've had this conversation numerous times in terms of the crossover and the blurring of the lines between these sectors. And so I think the most interesting operators are the ones that actually can be quite nimble between these sectors. And so there have been some interesting brands where they've managed to, you know, they can do short-term, medium-term, long-term, different age groups, whether that's students and stuff. And those are the guys, let's face it, are going to be the ones that can really maximize their returns and weather whatever storm gets thrown at us, right?
Mm. We work with Mason & Fifth, who are a co-living provider, actually, and it's really interesting. During the crisis, they kind of went to a different model. They actually rented a lot of their stock to NHS staff, and some of it was for free, which was nice. And their minimum period that you can rent with them is 3 months. but it's quite interesting. And obviously we work with Quintain as well on their build to rent portfolio, and they've got quite an interesting strategy in terms of getting people into a well-connected community where you haven't got just the resources of one site. You kind of got their wider Wembley Park estate, which I think is a really interesting model as well, particularly if someone's looking at a bigger acquisition or a master plan. You can kind of spread out your strategy then.
And Andrew, what about investor sentiment towards co-living?
Well, there's a lot. You know, there's a lot. It's an immature asset class, so it's not for everybody. But the whole co-living phenomenon was expanding a lot pre-COVID, and it will be accelerated during the COVID. You know, it has been accelerated during the pandemic. So next year, I'm sure it will continue to accelerate, because again, it's a really good business model. It's a really good business model. And you know, there's lots of interest in it. There's no question.
And just finally, because we really will have to wrap up shortly, James Fry says, do the panel believe guests will pay more or be more loyal to truly sustainable wellness brands of the future? Olga, I think you should kick off with that one.
I think we can only go off what we've seen in other sectors, and in other sectors there's a really good track record that this has happened. So people are paying a premium for offices that have both got sustainability and wellness as a USP, and people are paying more for residences that have that as well. It's still unproven and untested in the hotel sector, but if we're looking at trends from other sectors, and not least from the US where this has happened, there's definitely a lot of evidence to show that, and there's quite a lot of willingness to pay studies out there, particularly for the residential sector, but none that I'm aware of for hotels.
Mm-hmm. Adam, presumably the project you're working on, part of the rationale behind that is because the developer and the operator can see the benefits to the bottom line of being sustainable.
Yeah, absolutely. I think so. It's bottom line for the operator, as you said, and for the developer or the investor long term, because hopefully there'll be some cost saving. Now, a big investment initially, but yeah, there'll be some long term savings. So yeah, I think benefits for all sides. And then I think, you know, I think James is probably suggesting that, you know, the guests out there, there are a lot of businesses who want to be sustainable. So when they're sending their employees around the world, the benefits of being able to place them in an environment which is on brand with their corporate sort of, I suppose, responsibilities. I think there's a benefit of that. And if that's a small premium to that, I can imagine that, you know, they can take that up very easily.
Yeah, great. Thanks, Adam. Thanks to all three of you. And thanks again to Saxbury for sponsoring. This webinar is one of 3 that we're running this week for our respective sites, looking ahead to 2021 trends. Tomorrow, my colleague Eloise will be hosting the boutique hotel session. And I believe the link to register for that will be in the chat shortly. And then on Thursday, Paul Stevens will be hosting a short-term rental industry trends webinar. I think they will all be very insightful and very worthwhile, so I'd urge you all to register for those. In the new year, we will be launching our second urban living webinar series, starting on January the 13th, when we all come back refreshed after our break, and the link to the full schedule is also in the chat there. And now we are about to witness my acting debut.
Look at that. Oh my God. Joe, look at this. The numbers just keep going up. This Joe.
Amazing! Let's go, let's go, let's go!
More digital.
More digital? I'm on it. I need more sign-ups.
Sign-ups? I'll get you more sign-ups.
Justin, put these on socials everywhere now.
Consider it done.
I can't believe it. We've got over 500 sign-ups for next week's webinar.
Oh, hi, Mummy.
iPad. She loves that thing.
Well, I haven't appointed an agent yet, but who knows, the phone call might come. Thanks for watching, everybody. Thanks again to Saxbury. Thanks to our contributors, and hopefully see you on one of our webinars next year. Thanks very much.
Thanks.
Thank you.
Thank you. Bye.
Bye.